Hello and welcome. You're listening to Investing Ideas at the Angry Tiger Investment Club, found at angrytiger.com. I'm your host, Ryan Rupert, and my guest today is Ryan Hodson of Kodiak Capital Group, LLC. We have a special program lined up for you today, and we're going to cover an area of the market that we've never covered before, the OTC market. Now, Kramer stole my sound effects board, but if I had it, I'm sure that I'd cue a rather ominous clip, the type of music that plays in horror movies right when the young college kid decides it's a good idea to walk into that dark basement. But while most OTC stocks do lose money, a lot of money, there are experienced investors who find very impressive profits in that sector. The team at Kodiak falls into that select group. I have to stress a very important point before we begin. Investing in OTC securities is only suited for those with a very high risk tolerance. There is a very real possibility of losing 100% of your capital on an OTC security, and you should conduct much more due diligence on these companies. That's why many self-directed investors hire professional managers like Ryan and his team at Kodiak Capital Group to manage the portion of their portfolio allocated to the lower middle market. The other benefit, as you'll hear today, is that institutional investors often get better deals when they invest in these OTC firms than the regular investor. So let me introduce Ryan Hodson. Ryan is currently a managing director at Kodiak Capital Group. His career in finance includes raising capital and advising clients for Laidlaw & Co. He's also held a wide variety of positions, including working as a commodities trader for Iowa Grain, a financial analyst for Lincoln Financial, and a managing director of New York Consulting Group. If you like what you hear today and want to get in touch with the team at Kodiak Capital, you can call them at 212-262-2600 or visit them at kodiakfunds.com. Okay, now that we've covered the introductions, let's get started. Here's Ryan Hodson, Managing Director at Kodiak Capital Group. Welcome, Ryan. How are you today?
Doing well, thanks. Thanks for having me.
Well, thanks for joining me today. I'm really looking forward to what's going to be a unique show today because managers in the hedge fund and private equity space tend to be very secretive about what they're doing, and they certainly don't do a lot of interviews. So thank you very much for this opportunity. I'm really looking forward to an incredible learning opportunity for everyone who's listening today. So to get us started, can you tell me a little bit about Kodiak?
Yeah, Kodiak Capital Group, LLC, celebrated our 5-year anniversary, incorporated in 2009. We're structured as a private investment fund manager, actively managing a family of funds focused on making principal investments in both public and private companies worldwide. And we also run an incubator where we partner with private companies looking to go public alongside a commitment from our fund and perhaps a couple other funds as a syndicate.
Okay. So what would you say is unique about Kodiak Funds in comparison to the other investment vehicles that are available today?
Well, we put our heads together in 2009 in the downturn in the market when most people were walking away from the business, and we developed a couple of proprietary investment vehicles that are ideal for not only our investors, but the companies to which we invest in, the companies that we partner with. We invest through both equity and debt, and each one is a little bit different than the other, but how we typically explain it is we're providing capital to companies that are public, similar to a hard money loan, but in this case, instead of having a house or some piece of real estate or a car as the asset, these companies are able to put up their own stock as collateral and sort of paying us back within the first 12 months, or they can convert that into stock. So it's a win-win for everybody. We're also structured a little bit differently on the fund, on the investor side of the fund, where we take in capital a minimum of $25,000 at a time, whereas most funds require individuals that are looking to invest in a hedge fund put in the minimum of $250,000 to $500,000. So we've really opened up our doors to Middle America to get involved in the fund structure that we've put together over the last 5 years.
Okay. Now, in my introduction there, I mentioned that managers in your space rarely speak about their funds in public, and that's really often because of the regulatory environment that we're in today. So can you talk a little bit about that and what changes are coming for investors?
Yeah. As a matter of fact, right when we started our fund, we had to incorporate the Dodd-Frank Act into our original documentation, and now we're having to modify that set of documentation once again less than 5 years later because of the Jobs Act. As we all know, Obama passed the Jobs Act almost 2.5 years ago now. However, the SEC is still implementing that into their policies as well. So it's been a slow-going process for everybody, but once the Jobs Act is in full effect, which is highly anticipated by not only companies but funds and other investors like ourselves, it should change the market. And as a result, the SEC, FINRA, and other service providers or intermediaries, I guess, such as pink sheets or what they call OTC markets, are having to update their rules and regulations. So that being said, it's a very exciting time for all of us. We will be able to generally solicit investors, targeting primarily accredited investors, but as opposed to before, we're a Reg D offering, also known as a private placement, had to be done behind closed doors and was very hush-hush. And now, for lack of a better phrase, it could be put on the back of the Wall Street Journal. So it's really going to give investors the ability to review many more deals than they would have in the past. And on the flip side of the coin, it's going to give companies additional access to capital.
Okay. So you think that the Jobs Act is likely to increase investment in the mid-market, and possibly how would that affect valuations for your firms?
Well, a large part of the Jobs Act is what they call Section 3. It's the crowdfunding aspect of the Jobs Act, where it's going to give companies the ability to raise equity up to $1 million a year, primarily from accredited investors, by using media outlets such as newspapers, magazines, or news sources such as yourself. But most importantly, it's going to give them access to utilizing social media and letting people know through social media platforms or crowdfunding portals, as they're called, that they're out there raising capital. And if you want to learn more information or invest now, click here. In a click of a button, you own $25,000 worth of Acme Incorporated, or you've invested in a $25,000 note in Acme Incorporated. Just by clicking a button online. And it's really going to change. I'm not so sure about valuation. I don't think there's going to be a large artificial demand with money just flooding the crowdfunding market. However, it will provide a much greater access to capital for these companies, and like I said, a much greater access for investment opportunities for the accredited investors.
Okay. And do you anticipate that non-accredited investors will ever get access to this sort of program or funds like yours?
Well, this is the gray area that you talked about before. A lot of hedge fund managers don't want to go on record really stating an opinion because it's such an ambiguous market or an ambiguous topic at the moment. I mean, if you go through the Frank-Dodd Act and then you read the Jobs Act, they almost contradict one another. And every now and then you'll see FINRA perhaps having a policy that contradicts the SEC and so on and so forth. Without going into the specifics there, I will say that although the Jobs Act has gone through our government on a Congress level, the SEC is still slow to implement the policies to which the Jobs Act is outlined. As a result, most people believe the SEC is not a big fan of the Jobs Act. I do think that Once it is set in stone, you'll see more general solicitation as opposed to now the hesitancy. There are some companies out there that are generally solicited under Reg B. However, most companies are apprehensive to do so, and most investors are still unaware of this market. They haven't been educated. So there's a huge opportunity for platforms that not only allow investors to invest, but they educate them on the opportunity. I would say 7 out of 10 people, maybe even 8 out of 10 people on the street would have a hard time explaining how crowdfunding works, especially from a legal standpoint. And if you can't explain it, at least in layman's terms, from a legal standpoint, you typically want to stay away from something like that. So I think that once you see it set in stone, that it'll really increase the opportunity for companies to take full advantage.
Absolutely, absolutely. So for a person who's already invested in Kodiak, in one of your 2 original funds, is there going to be a major impact that they're going to see on their statements from the Jobs Act, or is it just going to be business as usual for them?
Yeah, so Kodiak Capital Group, LLC, is a fund manager of 2 funds. We focus on making investments in 3 verticals. The first vertical is a private equity approach. We target companies that have at least $5 million in EBITDA. That's about 10% of our portfolio. The second vertical is private companies looking to go public alongside a commitment from our fund. That's what we call the incubator approach. It's about 35% of our portfolio and growing. And then the majority of our fund is the VIPE approach, or venture invested in public equity approach, which is the majority of our fund. I guess about 60%, where we focus on companies that are already public, not only in North America, but worldwide. And it also includes playing the IPO syndicate calendar and getting involved in secondary offerings and so on and so forth. So that's what our investors signed up for, making private transactions across those 3 verticals. Our new fund is going to be the exact same. However, it's also expanding. We're expanding our horizons to allow other investors to get involved in the companies that we invest in. And as a result, 1, the companies in our portfolio are able to raise additional capital. And 2, it gives these investors the ability to understand how our fund is structured, how we work, how we get involved in investment, how we exit. And as opposed to investing directly into Kodiak initially, they can pick and choose which company they want to get involved in, and then as time goes on, if they choose, we can end up managing their capital for them.
Okay, well that's certainly interesting. So, looking at your largest vertical, the companies that are already public, can you talk to me a little bit about what your investment process is? And by that, I mean, how do you actually decide to invest in a company that comes across your desk?
It's a great question. Our investment criteria is as follows. We look for public companies that have a seasoned management team, a company that's been there and done that. Now, when we're venture investors, we don't necessarily require them to have a proven concept to date, but they have to have a well-thought-out business plan, and they have to be a proven management team. It always helps if they have a couple dollars in their into their company, a little skin in the game. And on top of that, we take a look at the use of proceeds. How much capital are they raising? How are they looking to structure it? And what's the relative size of that capital that they're seeking in relation to their market cap? In other words, if we're looking at a company that has a $100 million market cap and they need $50 million, well, that's way outside of our funding threshold. We tend to commit no more than $10 million per transaction. The use of proceeds in a $100 million transaction, if they're looking for $50 million, we're not majority investors. We're looking to take a minority stake, which is typically no more than 10% at a time. So once we've gone through that aspect, those 2 aspects of diligence, and gone through some Q&A on the operations and gone through their filings, we can never be brought over the wall. The information we have to make a well-informed decision is that which they file with the SEC in annual statements and their quarterly statements. If we like what we see, we issue a term sheet. Once the term sheet's signed, move on to legal documentation, a stock purchase agreement or a registration rights agreement or perhaps a warrant. And once those are knocked out, we close.
All right. So how do these...
It's about a 40... I'm sorry, I didn't mean to cut you off. It's about a 45-day process.
45-day process? Okay. So how do these deals actually come to your desk? Are these companies actively soliciting firms like yours, or do you search for them?
Right. Well, initially in 2009, we got the backbone of the fund put together for October, November, and December of 2009, but we were able to really hit the ground running in January of 2010, having done about 6 deals in the first 6 weeks. And at that point, there was no looking back. We had a multitude of referral networks. Even our own investors were bringing us deals. A lot of intermediaries such as banks, attorneys, accountants, deal brokers, if you will bring us deals. And then word of mouth gets out there. Generally, companies will contact us directly looking for capital.
Okay.
Yeah, it's no longer the days of having to bang the phones and calling to introduce the funds, because everyone calls in typically knowing who we already are and deals that we've been involved in and what our expectations are and so on and so forth.
Okay. So how many opportunities would you look at in an average month, and of those, how many would you select?
We typically see about 750 deals on an annualized basis, to which we'll pick approximately one a week, about 50 deals a year. 50
deals a year. Okay. All right. So in today's market, do you find that, and by the sounds of it, it seems like you're more limited by your fund, your capital base, than by the number of high quality deals that are available to you?
Correct. Well, at the end of the day, you've got to take a look at how much capital do you have to allocate towards X amount of transactions. And as a result of that, we're fairly selective with our deals. A lot of our companies are very early stage, but we try to get in right there at that inflection point, where a lot of the other opportunities, a lot of the other funds out there don't see the opportunity. We see opportunities that others often miss, and they can be perceived as highly risk type transactions. However, we tend to structure them where they make sense for both parties, and go from there. So we'll do 50 deals a year, combination of equity and debt, anywhere from $250,000 to $5 million commitments. And then the company usually will close all at one time, or sometimes we give them the ability to utilize our commitment over a 6 to 12 month period.
Okay. Now, one of the unique parts of your business is you obviously have to look at business plans and unproven business models. And one of the challenges that I imagine that you have is on valuation. So how do you look at a firm and determine the value of a business plan or an unproven concept?
Well, as a sector agnostic fund, we tend to look at all opportunity. However, we're very active in life sciences, natural resources, consumer products, and social media. Under that consumer products vertical, we've been very active in the cannabis industry and the vaping business, or also known as electronic cigarettes. Those companies, their book value compared to their market value, or what their market cap is, seldomly you see a correlation between the two. And that's when we really have to go in and work with the company on a valuation that makes sense. For instance, there was a company that we were making a rather sizable investment in alongside a couple other funds earlier this year that was in the electric cigarette business. And at that time, the company had a $2 billion valuation and only $3 million in revenue. So we had to crunch the numbers based on their business plan. That was a debt transaction. They were bringing in the capital to make a multitude of acquisitions, buying revenue, cutting costs, and ultimately that's going straight to the bottom line. We had to take a look at that and come to a valuation that made sense. So if we ever were to convert that debt into equity, it's at a valuation that we feel very comfortable with. So there, the company was trading at $2 billion valuation in the market. However, we ended up negotiating a deal to convert at approximately a $400 million valuation, which we thought was more appropriate.
No.
Here we are 8 months later, and the company's trading right in that valuation zone that we had anticipated, right between $4 and $5 a share.
Yeah. Is that e-cig?
That is correct. That is Electronic Cigarettes International.
All right. So
ECIG.
Yeah, looking at e-cig as an example then, what was compelling about the company that made you guys decide to invest in it?
They're right back to what I alluded to before, the two main items that we look at, management and use of proceeds. They have a phenomenal management team. Their CEO, West Point graduate, has been involved in a multitude of distribution centers in the past. Brent Willis, he really led this round. He was out there not only operating the company and looking for acquisition targets, but at the same time negotiating transactions. He went out and raised an initial $2 million. That $2 million was followed by our round of $15 million, which was immediately followed by another round of approximately $85 million. So in 1 year, you want to talk about an incubator type transaction. e-cig, formerly known as Victory Brands, was a private company doing $3 million in revenue. They went public, raised $100 million, went out, made 7 acquisitions. They're on a run rate for 2014 to do $220 million in revenue. In the Nielsen report that came out that ranks all of the sales within the convenience stores nationwide, has ranked them as the #1 company in the U.S. So that was a real venture type transaction. It was structured as a convertible senior secured note, and they've done all that in the last year, and now they've brought in Wells Fargo, and they're on the verge of going public on the NASDAQ here in the coming weeks ahead.
All right. Well, that's an incredible story. But for investors who decided to invest in the equity at the same time as you, the story hasn't been so happy with e-cig. They've lost a ton of value there for the average equity holder, and I think that's part and parcel to why it's important to get involved with a firm like yours where you can actually get a special price in on these companies. But do you think that equity holders are now in a position where they're going to see some capital appreciation?
Another great point. Absolutely. Before I elaborate on the company itself or e-cig itself, let me just make a note on what you just said. Companies seeking capital see the value add in institutional capital, right? And as a result, they will work out a deal that makes sense for both sides. So as opposed to a retail investor putting in $50,000, if an institution's put it in $500,000 or $1 million+ into a private transaction with a public company, they're going to get much better terms. So we encourage the average retail investor to take a closer look at exploring Kodiak and private investment funds in general when looking to make investments in the lower middle market, because it's a very volatile space. You have to know how to read between the lines with reverse mergers and self-underwritten IPOs and companies that are trading on the OTC markets, which is constantly changing their criteria, whether you're trading on the pink sheets or the OTCQB or the OTCQX, and you really need to understand the difference. And nowadays, back to your regulatory risk, or what we like to call counterparty risk, it's not the companies that we're investing in. It's not our ability to manage a fund, but it's what's coming around the corner the next day. You know, will I be able to clear my stock? Will I be able to trade my stock? And that's why we tell all of our investors, if they're investing on their own, to tread lightly and make sure that you're making a well-informed decision. Typically, the best way to do that is to rely on a fund to do it for you. So e-cig, as an example, There were a multitude of people that jumped at the opportunity at $20 a share. It was the only publicly traded electronic cigarette company for some time, and therefore it had a lot of attention. No one paid attention to the market cap. They just paid attention to the fact that it was public and they could get a small piece of the pie. However, e-cig did a reverse merger, which is when a private company goes public through merged with an existing public company. And there were other shareholders that were already holding the stock that decided to sell on the way down. And then the company went out there and they raised an abundance of capital, over $100 million. They brought in the former CEO of Walmart, who has been a great addition. He brought in some other investors. And although the company is well capitalized, they have issued a bunch of stock, and that dilutes the overall market. Seasoned funds, though, will put in what they call ratchet protection. So for every share a company issues, the institution is protected, because for every share that is issued, it's basically a ratchet, an anti-dilution clause. So I do see significant upside for e-cig. It will be one of the only pure-play electronic cigarette companies out there on the NASDAQ. They have the top banker and top analyst covering them in the space, that being Wells Fargo. They have 3 other underwriters, Societe Generale, and 2 other well-known partners. And I think that the future is bright for the industry. It's outgrowing expectations. It was anticipated to be a $2 billion industry by the end of this year. Now the projected $3 billion industry. Overall growth has slowed down a little bit. That's only because overall market share growth has slowed down a little bit, only because you have a multitude of other players coming onto the scene. I will add they're all undercapitalized, or majority of them are undercapitalized players. So everyone's looking to come in and do 10, 20, 30 million in revenue in the first couple of years, and then potentially put a target on the back for acquisition. So I think e-cig is definitely in acquisition mode, and simultaneously they're organically growing as well.
Well, thanks for that. I really think it's very important for investors to have a manager like yourself in the lower middle market if they want access to that OTC market. And it's all for the points that you mentioned, because for people who are managing their own money, larger companies, fund managers like yourself won't enjoy special pricing on shares of, let's say, Apple or Google or Exxon. It's simply they'll get the market price for that. But on a lower middle market deal, I just want to reiterate this. You do get special deals because you do come in with a lot of money, and these firms obviously want that institutional funding. So I want to ask you, are there cases, though, because of the regulation in the markets that you're dealing with, where things don't go so well? Because e-cig is clearly a success story for your firm, but are there cases where things don't work out?
Yeah, the industry to which we invest, whether it's Kodiak 1, 2, or 3, being our new fund, you definitely come across a sociopath or someone that just doesn't do what they said they were going to do. 10 out of 10 times, if I tell you we're going to do something, we do it. Fortunately, 9 out of 10 times, if a company says they're going to do something, they don't. I will add, going back to e-cig really quick, that's really what separates them from the majority of the portfolio. They've done everything they said they're going to do, and then some. As opposed to other companies, since inception in 2009, we've participated in over 250 transactions to date. A lot of them we've dealt with less than scrupulous individuals, guys that they will take money and they will disappear. Companies that will be traded one day and they won't be traded the next, and it's something that we have to deal with. It's a very small percentage. We have in-house counsel that addresses these issues, and great great custodian and fund administrator that assists in the process. Every now and then, we'll find that our in-house counsel is playing collections agent. But, we're very fair. We try to work with our companies. We're trying to help them grow. We're not trying to be a burden. We are partners. But just like any industry, someone's having a bad day, sometimes they take it out on you. And although we're not typically a primary target, every now and then, management won't do what they say they're going to do, and we have to go into what we call attack mode.
Absolutely. And you mentioned that one of the areas where you're particularly active is the cannabis market. And that was particularly interesting to me because there's been a lot of information out there. There's a lot of articles that have come out from the Wall Street Journal and other respected media organizations that have said that the majority of the companies, or at least a significant portion of these cannabis firms, are basically fraudulent firms, or where management is just not experienced, not meeting expectations. Obviously, you come across a ton of deals every year. How do you make a determination that you're confident in the management?
Right. A good management team is a seasoned management team. People that have been there, they've done that. What we call proven. And they're also a management team that will invest alongside investors. We want to see skin in the game. So we want to invest, as silly as it may sound. I mean, we want to invest in guys that we want to have, beer with, or go play golf with. People that we understand one another, we trust one another, and we rely on one another. So they rely on us for capital just as well as we rely on them to execute. Right? You can put together the right team, and you can certainly prepare. We see this all day long. But what really separates the effective management teams or the efficient management teams and from the ones that don't are the guys that can execute. And regarding the cannabis business and how that applies, over the last 12 months or so, you've seen a cannabis company popping up on a daily, if not a few cannabis companies popping up on a daily basis. A lot of them will suddenly go from operating a pizza shop or a coffee shop or making some sort of widget to being the next big cannabis testing laboratory or cannabis distributor, so on and so forth.
Yeah.
You really need to weed them out as an investor. And we bring in third-party due diligence teams to vet them. We do background checks, and we typically get a pretty good security blanket or security coverage, asset coverage in our investments. So there's that protection. We even take it one step further with a transfer agent, the group that's responsible for issuing shares to investors or shareholders in the company, will even allocate a portion of the stock. They'll set it aside for our fund. So at the end of the day, if the company were to ever default, there's that stock sitting there that we can always collect.
Yeah.
There's a marijuana index out there that went from $10 back in January, shot up to about $100 in March, and now it's down around about $2. And they've done some readjustments. They've taken some companies off of there, but that's on an adjusted cost basis. I mean, $10 to $100 and back down to $2. It can show you that FINRA and the SEC have really had an impact, whether you want to say it's for better or for worse, on this market. They've both issued letters telling investors to be wary when investing in cannabis and to do your homework, and they're absolutely right about that. However, there have been a bunch of examples, we've been involved in one or two, where we make a private investment in a cannabis company, and then either OTC Markets, FINRA, or the SEC come in and will suspend trading or put a caveat, what they call skull and crossbones, on the buyer beware on the stock. I understand that that's the way of warning the market or preventing additional investors to purchase stock, but I don't want to go too far off topic here, but it's a good time to bring up the buyer beware should also apply to them, because if we have $1 million behind a cannabis company and John Smith down the street has put a bonus of $25,000 into the same cannabis company, the next day we wake up and we can't get out of that position, Well, yeah, you may have protected new investors who can make a well-informed decision by simply reading your newsletter. They can make that well-informed decision. However, we're left holding the bag, and that's something that really needs to be worked out. And if anything comes out of some of these smaller cannabis companies, I hope there's some sort of class action from the shareholders that have put millions of dollars into these companies that have already been delisted in the last 6 months.
Right. Well, that certainly makes sense, and I can say from experience, Angry Tiger actually has a space on its site for people to submit investment ideas, and that's part of how we find people to interview. And I'll tell you that the vast majority of ideas that I seem to get right now are cannabis, and I almost have a email filter. I'm thinking about it because it's very difficult to filter through these ideas, and that's where someone like yourself, I think, is very valuable to investors.
Absolutely. I mean, we have not only as myself and our other managing directors and our founders of the funds, we have a pretty good mid-office, pretty good size, I should say. They're great staff, pretty decent size of 10 mid-office staff that do a great job of doing research and provided a pretty in-depth analysis to our investment committee. And on top of that, we also have an advisory board that advise us on a case-by-case basis. A lot of them having come from the either medical device or life science / biotech industry. They have a very strong focus and knowledge base of the cannabis industry. As a result, it's pretty easy for us to vet the teams to which we're talking, and we can clearly spot a good opportunity from a not so good. Most recently, we just made an investment in a company called Abatis. Abatis is traded here in the U.S.
What's the ticker on that?
It is on the OTCQX, and the ticker symbol is ATTBF.
Okay.
That was a $5 million commitment. The company has been putting out a bunch of press to date, informing the market that they're getting their licenses in Washington to set up their testing laboratory, and they're also anticipating licenses in the coming weeks in Nevada as well. Seasoned management, great market cap. Relative to the size of the commitment. In other words, we felt that we didn't have to put in an abundance of capital for them to really get past that inflection point. We're the only institution involved. Something else that we look for. We don't, although we don't drive decisions directly, we don't want too many hands in the cooking jar. We like the management team to stick to their initial business plan. As a result, we like to keep other institutions out if possible because they can tend to steer management the wrong way. It's $50 billion illegal market, as they say, until the federal government, when we get a little bit closer to election time, start taking a closer look at that. But it's still a $5 to $7 billion legal market. And although there's a huge risk to reward ratio out there, that's exactly what we look for as venture capitalists. And when these companies are fully reporting, as opposed to a lot of the private opportunities out there, it gives us the comfort that we're relying on audited financials that have been filed with the SEC, and that'll help us make a well-informed decision that we can rely on at the end of the day.
All right, sounds like an interesting company. And you referred me to OTCmarkets.com to find the most up-to-date information on over-the-counter stocks. And I think that's important because oftentimes if you're using the other platforms out there, they won't be up-to-date with the valuations. So I see here that there's a $13 million valuation today for Abatis. Can you share with us the valuation that you purchased the shares at?
The nice thing about the way we structured the deal with Abatis, we allocated the capital to them that they needed. That was the $5 million number.
Yeah.
And we've given them a year to utilize it.
Okay.
To follow how much they've utilized, you can reference their public filings on the SEC website. And as far as the valuation goes, we're purchasing their stock in what they call a registered offering. So Abatis files a registration statement with the SEC. The SEC, and then we purchase the shares off of that registration statement at a discount to the market.
Okay.
So it's not a fixed price. It's what they call a floated price based on the time that the company chooses to utilize it. And it's an ideal situation for companies that they not necessarily immediately need capital today, but they foresee that they're going to need it in the future. So that's why we take a look at the use of proceeds based on a timeline, next 6, next 12, next 18 months. We allocate the capital to the transaction accordingly.
Oh.
And then they can choose at which point they take it down, in effect, creating picking the price as well.
So then what would your discount to market be?
You're looking at 25. So basically, if we were to close a transaction today, we would be purchasing the stock around 20 cents.
Okay, so theoretically today, Abatis could elect to accept your funding and say take $1 million, and you would purchase the shares at 20 cents per share today, correct?
Exactly.
Okay.
Exactly.
All right, well, that makes sense. Now,
and I will add, Abatis has about $4 million in cash right now.
Okay.
So, and they're in acquisition mode. They're growing, and they're waiting for a couple more approvals from the state of Washington and from Nevada. They have the capital to execute on a day-to-day basis, keep the lights on, and keep up with their burn rate and whatnot. They've got ample cash for that. However, when they go into acquisition mode and pull the trigger on the acquisitions that they're identifying, that's when we're going to come into play.
Okay. And when you purchase your shares at that discount, is there a hold period that you're required to keep to, or can you just trade
in this particular transaction? Where we are quite influential in the market. Typically, when a company puts out a press release, they've aligned themselves with the institution, and let them know that it flows on a substantial amount of institutional capital. The market typically pops between 20 and 30%.
Yeah.
As a result, we do registered offerings where, hey, if we're going to put in large amounts of capital and there's other shareholders that are already involved, which can be perceived as overhang. You know, if I'm coming in with $5 million today, there's already $10 million in behind me.
Yeah.
I want to make sure that those 10 million guys aren't banging, or $10 million worth of stock aren't banging the market while I'm waiting to get out. You know, God forbid the stock goes from $1 to $2. Everyone else is getting out. I'm the largest investor and I'm restricted. So in a situation like this, we do what they call a registered offering. And as a result of the registered offering, the shares will be free trade.
Okay. All right. So obviously you do have that discount in place, but from what I'm hearing from you, what you're saying is that Abatis right now would be fairly valued to an extent, despite the fact that it is still in a very popular industry to invest in right now.
Yeah, I mean, the company is basically traded 3 times cash. If you look at the industry for the well-capitalized cannabis companies, the multiple is about 8 times. So I see they're undervalued. I mean, we were committing capital to them when the stock was at 50 cents, right?
Yeah.
So I wouldn't be surprised to see the stock at 50 cents.
Okay.
There's a lot of buyers at these levels here, so we'll just have to wait and see what happens.
All right, well, that's interesting. Now, one of the structures that you mentioned to me today was where you use the equity of the firm as collateral, and I wanted to ask you more about that because when a company defaults on a loan to you, that you've provided them with, when they default on that, you end up with shares essentially in a firm that is no longer able to meet its creditors' demands, essentially. And the shares are also traded on the OTC market where you won't have a ton of liquidity. So how effective is that at protecting your capital investment?
Let me preface that by saying that liquidity is a relative term, right? In other words, we're not going to get into a $5 million deal structured like that if the company isn't trading a couple $1 million worth of stock on a daily basis, right?
Yeah.
So if a company's trading a couple $1 million worth of stock on a daily basis, and I put in 100,000, now it's a different ballgame. So liquidity is relative, and another thing we do as an advisor, we gauge all of these attributes, all these characteristics and metrics of the company before we get involved. And basically the black box that spits out a number that makes sense. So just keep that in mind. Now, Let me just recap here. I just want to let me just give a quick snapshot, and I'll roll into the question. So Kodiak Capital Group, LLC, is a fund manager, and we've been around for 5 years, since 2009.
Yeah.
We've now going into our third fund. The learning curve has been tremendous. There's not a day that goes by where we don't learn something that would benefit us and the company moving forward. As a result of that, this particular vehicle that you're talking about, it's as simple as a convertible promissory note.
Yes.
Now, not a lot of bells and whistles. We don't require warrant coverage. There would be a venture coupon attached to it, or interest rate of, say, 15%. It would be a 12-month term. The company can prepay it. There's typically a modest prepayment penalty.
Okay.
Or they cannot pay it back, and it can convert into common stock. That isn't necessarily because they're defaulting. It's because they realize that they have the stock may be up, and they realize there's a better use for that cash. And as a result, they'll have us convert into stock, and they'll take that cash that they're going to use to pay us back and put it into the operations.
Okay.
So, and that's a common trend. It's a common trend. And unlike a traditional hard money loan where we put $1 million into a company and they put up their building and they put up the CEO's Ferrari, and we need to put a lien on his assets or whatnot, here, there's no real default. It's either you pay us back or we convert it into stock.
All right.
So it's a friendly relationship with these companies. And the whole idea there is there's a multitude of companies out there that are looking for immediate capital.
Okay.
And our investors are looking to do an abundance of deals to diversify the portfolio.
Okay.
So we can identify no less. I mean, if we tried to ignore them, they'd still show up no less than 5 opportunities a week, right?
Right.
These companies need the money. So we'll go ahead and we'll commit $500,000 to the company to utilize in, say, tranches of $50,000 or $100,000. They can close within a 3-day period, and then they have 12 months to pay us back.
All right.
And we also have the option to convert. The conversion option is at our discretion.
Yes.
After 6 months, so they can play it many which ways. Sometimes they take our capital and pay us back with it. It really depends on the deal. It's a case by case situation scenario.
All right. So we've discussed 2 interesting deals today, the eSig and Novatus, and we've also mentioned the market in a broader term. And we've talked about a lot of the risks that come with the lower middle market. Are there any risks that you don't think that we've adequately covered for people to that, specific to the lower middle market?
Do your homework, make a well-informed decision, read through the quarterly statements, read through the annual statements. If there's something you have a question on, these companies, they have this fiduciary responsibility to get back to their shareholders.
Yeah.
If they're really caught up in operations and it's a larger company, the CFO or the finance director may refer you to their IR group. Good IR firms are very well seasoned in being able to break down a financial report. I would encourage you, though, to also bring in an advisor or do your research on funds and try them out. We are currently taking on new investors for our third fund, and we not only manage the money, but we also we like to share our passion.
Right.
We don't have office hours. If we have an investor that needs to talk to us, we make ourselves available. We also have a fund administrator that will handle all the paperwork. If you have a quick question or whatnot, they're well trained in that. So the whole idea is to be accessible when needed to help these guys, our investors, make well-informed decisions and then act in their best interest as a fiduciary and structure investments that not only make sense for our fund, but make sense for the companies that we're getting involved in, which really helps preserve the longevity of the relationships of our portfolio with our portfolio.
All right, so I've got to ask, because Kodiak is a young firm. It has a 5-year record right now. It was founded in 2009, but that means that you weren't exposed to the credit crisis that we saw in 2008. So can you comment briefly on how your firm would react to a credit crisis and how specifically you would protect your clients' capital in the event of a crisis like that?
We all come from a long line of money management and private equity fund management, as well as venture capital management. So we've dealt with early stage companies all the way up to the most seasoned companies. We've seen early companies fail. We've also seen early companies succeed, and that goes the same with larger companies. We've seen multitude of companies throughout our careers crash and burn despite how large they are. And that's really what Kodiak was built on. The crash in 2008 left a lot of people without a job and left a lot of uncertainty out there, not only for what the future is going to bring financially, but really where's the country going as a whole. And we put together a strategy to help our investors and ourselves. I will add, we're all of our partners here are invested in the fund. We invest alongside of our investors. We've put together a strategy to insulate ourselves from that market risk. The notes protect our investors, protect our downside, as well as our equity investment have a multitude of covenants that would protect us in a downturn in the market. As a result, we manage the fund accordingly. We're not going to sink. We learn from our own mistakes. We're not going to sink or commit $10, $15 million at a time to a small cap company, anticipating their growth and then being able to grow into our commitments, if you will. If they have a $5 million market cap and we're committing $5 million to them, and we can only own 10% of the company at a time, they're really going to have to show significant growth. So we've learned from that mistake of overcommitting capital, and now we have more modest commitments where we test the waters. If the company has a business plan, they share it with us, we go through the use of proceeds, get to know management. We'll test the waters. We'll start with a small position. If the company executes and performs well, we'll re-up. As opposed to committing a large portion of capital to a company and having them fail, and now we still have this giant commitment out there, and we can't utilize it because the company hasn't grown to our expectations. So our fund documentation, our fund structure is insulated to risk because of the mistakes that we've all made and learned from over our, I guess what you would call experience over the last 15 years.
All right. So your third financing's coming up. How much money are you looking to raise this time around?
So for our third fund, we are looking to raise $25 million.
Okay.
We already have a portion of that circled. We've just completed, as of October 1st, the fund documentation, and we're actively approaching not only our existing investor base, but a new group of investors. We're not looking to raise money from 100+ investors. We're looking to keep it small. We have a very tight-knit community. We all have a passion. Our investors, some guys may not understand what they're necessarily getting involved in, but that's why they're bringing us in, because they don't necessarily understand the small cap market. They've tried, they've been burned in the past, and now they're hiring a pro to manage their assets for them. And it's going to be a $25 million raise. We're looking to wrap that up by it's what they call a rolling close. We're looking to wrap that up by the end of the first quarter, but simultaneously we're starting to make investments in that third fund here at the end of the month.
All right. Well, that sounds good. I wish you the best of luck with that. And so this is, I'd like to hear the growth. How much did you actually raise in the first two rounds of financing?
The first two funds combined, it's a number that we don't disclose to the general market. And, you led with hedge funds are typically keep to themselves, and that's really the only thing we don't share, and that's really to protect our investors. They don't really like for us to disclose a lot of that material, and as a result, we choose to comply.
Well, no worries. I had to try. I wanted to, you get someone on the line, you've got to go for it.
I don't blame you, but I will point you to our website, KodiakFunds.com, FUNDS.com, and you can take a look at a lot of the news releases that have been put out by our portfolio, as well as our transaction list. Our new website goes live on Tuesday, and it'll have the majority of our deals on there. Another thing that funds don't like to share is their portfolio. Yeah. But we're opening up our past portfolio now to the market.
Oh, well, that's pretty extraordinary. You don't see that very often, and I think that's going to be a fantastic resource for investors. And just as we prepare to wrap things up here, you're in a tough industry, starting up a hedge fund, private equity fund here, and you've clearly succeeded. So, looking at that success in the rearview mirror, what led you to succeed where so many others have failed, and how are you going to continue that?
It's our passion for the industry. We eat, sleep, and breathe what we do. We're a young group of fund managers. We realize that this opportunity may not be here for the taking 10 years from now. The lower middle market is certainly consolidating, primarily due to regulation, and we're doing our best to take full advantage of that now. And we've got a great team. We're well prepared, and we certainly know how to execute. That's been proven over the last 5 years. We structure our deal so they're fair to both our investors as well as the companies to which we invest in. Our management teams love working with us. All the testimonials are on our website as well. And, it's really a relationship-driven business. And I don't want to use too many proverbs, but these teams that we work with, not only internally, but the intermediaries being the auditors, the accountants, and the investment bankers that bring us deals, they all stick tried and true to it's not what you know, it's who you know. But in our case, it's a little bit of both. We know a lot of people in the industry. We've really made a name for ourselves, and we've really taken our past relationships to drive deal flow. And when you see the majority of the deals crossing over your desk, you can tell, the private equity market right now in 2013, and again last year in 2012, is thriving. 2009 was a slow year. We still did 36 deals. 2010 started to pick up. 2011 was a little bit stagnant. And the last 2 years, it's really taken off. There's a ton of cash on the sidelines. There is more deal flow than I've seen throughout my career in the last 15 years, and as a result, we can be pretty selective. And to date, we've made great decisions, and we anticipate that keeping up over the coming years.
Excellent. And are you compensated based on performance or the size of your fund?
So our first fund was based strictly on performance. We did the same thing in our second fund as well, but now in our third fund, it's the standard 2 and 20, 2% of the assets under management, now that we have a proven track record, and 20% of the profits. We do not target institutions or pension funds. We're strictly catered to high net worth, again, primarily domestic We will consider international investors, but we like to keep things really simple.
Okay.
All
right, well, that makes sense. Well, thank you very much for coming and speaking with me today. Before we finish, I have one more question for you, and that's because we're talking to retail investors today. Is there any parting advice that you would give to a retail investor who's listened to this interview today and wants a concluding thought on it?
Absolutely. The typical retail investor that understands there's money to be made in the lower middle market and small cap arena needs to understand that there's a lot of smoke and mirrors out there. You may have a buddy that's made a fortune on one opportunity, but I can tell you that if you were to track every company out there on the bulletin board, it's about 12,000 companies. Over the last 3 years, the majority of the companies are down. Yeah. So if you were to play every single company, if you were to put $1 into every company over the last 3 years, you would be down a significant amount of capital. As opposed to what we do at Kodiak, we make private investments that are structured. And they're structured because these companies need the capital, so they're willing to work with you. So as opposed to an investor going directly into the market and buying stock at $1, a fund, because we're putting in a larger portion of capital directly into the company straight onto their balance sheet, we're getting stock at a discount to market. Or on the flip side, we will do a debt transaction and we will be able to convert into equity at favorable terms. So I would advise any retail investor out there investing in companies that are on the bulletin board, whether it be the pink sheets, the OTCQB, or the OTCQX, to do your homework and take a closer look at private investment funds like ours. You can find out more information about us by checking out our website, again, KodiakFunds.com, following us on Twitter at Kodiak Capital, or I would encourage anyone that has any questions to give us a call, 212-262-2600, and we're more than happy to answer any questions you may have. And I will conclude by saying that we are so open to becoming an advocate in this market. This market lacks advocacy. So we are trying to be that advocate. If an investor has a question about an opportunity, give us a call. Even if it's something we're not involved in, I'd be more than happy to talk to them. We are opening up a platform, a crowdfunding platform in 2015, giving investors the ability to invest in companies that are in our portfolio, each individual opportunity at a time. So perhaps you don't want to get involved in a fund initially. You want to watch it from afar. Well, if you see us announcing a deal and you want to get involved in that deal, you'll be able to go onto our crowdfunding platform and invest in that deal, as a one-off investment. And then as you see how that investment is managed in that particular company, you can then take it from there and either invest in a multitude of individual opportunities at one time, or by investing directly into Kodiak's funds.
Well, it sounds like an incredibly unique opportunity. Thank you so much for coming out today. Really appreciated the insights, and I think we had a great and productive conversation today. So take care, and thank you very much.
No doubt about it, and thanks for having me.
Well, that concludes what was a very interesting interview with Ryan Hodson. As you can tell, investing in the lower middle market requires a unique skill set, but can carry great rewards. If you are thinking about investing in OTC securities, remember that Kodiak Capital Group and institutional investors like it have a substantial advantage over retail investors because they are able to get stock at a discount to market, which, along with the high risk, is why you should strongly consider hiring a money manager if you want to participate in that sector. With that said, if you'd like to chat with Ryan and his team, you can call them at 212-262-2600 or visit them at KodiakFunds.com. It's also worth noting that many sites that offer equity quotes don't have up-to-date information for OTC companies. For the most reliable information, visit otcmarkets.com when you are doing your research. Now, before I let you go, I need to conclude with some important disclaimers. None of the information discussed today is meant to constitute a buy or sell recommendation for any securities, nor is it investment advice. Past performance is not indicative of future results. Always do your own investment research and be sure to include multiple sources of information. Investing in OTC or lower middle market firms carries very high risk. While all investments carry the risk of capital loss and may lose up to 100% of their value, OTC securities are much more likely to lose value and potentially lead to a 100% loss of capital. Ryan Hodson disclosed that he, Kodiak Capital Group, and his clients are long Electronic Cigarettes International Group and Abatis Bioceuticals. Since Abatis Bioceuticals is involved in the cannabis business, it is also exposed to substantial legal and political risk, which investors should be aware of before investing. This interview was taped on October 9, 2014. Ryan Hodson's positions may have changed since this interview was taped. We believe that all of the information presented in this interview is accurate, but we cannot guarantee it. This interview is subject to all of Angry Tiger's terms of use, found at angrytiger.com/terms.